It seems the whole country is talking about alternative investments and uncorrelated assets these days, but all the investment vehicles, I think you might be one of the most unique ones I've seen. Traditional perhaps, but very unique, and one frankly I'd never heard about until getting to know you and the team these past few months. Perhaps obvious now, farmland funds. Stephen, can you give our audience a short primer on Veripath, on the firm, the team, really a short bio on your capabilities and credibility so we have an appreciation on how you got here?
Yeah, and so why don't I share my screen? I've got a slide that sort of has some bullets. It'll make it easier to walk through. So let's...
You're good.
And let me start the slideshow so we got full screen. So at a really high level, what Veripath is trying to do, Veripath is obviously a farmland fund, and we are trying to capture a very unique set of characteristics the farmland exhibits, and those are particularly very over medium to long term time frames, very consistent nominal rates of return. And these returns are really they're non-volatile, particularly they virtually lack any downside, like any negative volatility, which is really important. And something that when we initially started in the farmland space, which is now 13 years ago, which was on our radar, but really never really factored into our thinking as far as being a return driver, was that farmland is really very effective at hedging inflation or stagflation. And so there's some interesting return characteristics, and we're trying to do that in a way that strips out short-term commodity price and operational volatility, right? And that's really important. And so if I can just continue in that vein and summarize, what we're actually capturing. So we're capturing a very pronounced value proposition in Canada. Canadian farmland on a productivity adjusted basis is the least expensive in the developed world. Very low historical return volatility, as I've mentioned, and coupled with uniquely very consistent nominal rates of return. There's a trade-off there. If you're looking for portfolio construction tools, farmland is one of the things that genuinely lacks correlation to traditional assets over long terms and episodic correlation, which is important. Very high Sharpe ratios for those that are on this webinar and are building portfolios through the lens of Sharpe ratios. Farmland in Canada by province is in the range of sort of 1.2 to 1.5 Sharpe ratio. And in the way that we do farmland, which is stripping out operations, stripping out commodity price volatility, cash renting the land, a very scalable approach. And we can manage very large portfolios. And of course, the benefit of scale is it enhances returns because your per acre operating costs come down, right? So that's kind of where we are.
Brilliant. And how did you get into this business in the first place? It's obviously remarkably unique and something that I've got to believe you've got a history in before 13 years got in front of you. But give us a short primer on the expertise.
Yeah, and so my partners and I come from very traditional private equity backgrounds. We do actually manage alternative assets in a number of other strategies, SME private equity, private credit. We're very familiar with the alternative investing space, and in my previous incarnation, I was actually the head of emerging market private equity for a French bank in London called Société Générale. So, really experienced from the private equity perspective. And we were looking for ways to get exposure to the incremental demand for soft commodities coming out of the developed market, but expressed in a politically safe part of the world. And so when you think of it through that lens, you naturally land on farmland. And we started some of our first farmland vehicles now 13 years ago. And in fact, we created the first RSP eligible farmland fund in Canada. So we've been doing it for a long time. What's new about Veripath is it's a unique structure and it's an open-ended vehicle, which allows long duration investors to coexist with short duration investors, which is really, really important, right?
That's very unique, and I have to confess, since the launch, the number of folks that have reached out to learn more about the strategy, it continues to astound me. Frankly, it's something that, as I said, we haven't seen before. Obviously, with a track record and a history behind you, I think that makes you guys quite uniquely positioned in the market. Never mind RSP eligible. I didn't realize that was even in scope for you guys.
Sorry, that was in our historical closed-ended vehicles. The open-ended vehicles are not RSP eligible.
Gotcha.
By the process of going open-ended, we have to eliminate the RSP eligibility.
Got you. Hopefully in due time with some additional unit holders, we'll bring that in. So I'm curious, this year's been a fun year. You shared some pretty interesting statistics as far as correlation to equity markets, and then obviously leveraging Canadian greenfield farmland to build your portfolio. How's it performed this year? What does it look like from kind of year-to-date perspective?
So we did our official launch in June, so it's probably a bit premature to talk about returns, although historically farmland is actually very dependable. Stripping out the sort of value proposition in Canada, over the last 60 years, Canadian farmland has appreciated nominally at a rate of about 10% a year. What I think is probably perhaps more relevant for Veripath, and to sort of give you some idea of how we're doing, since our official launch in June, we've gone from effectively zero to what is now approaching 60 million of AUM, which is a reflection of that we have a lot of experience in the space. This is generally a very interesting asset class, and we're capturing a very pronounced value proposition, which has created demand and appetite for the investment. And certainly, through our partnership with DealSquare, we're now, we have a very efficient way and a very simple way for people to access the asset class, right? So it's kind of a nice confluence of all those factors, which is generating a lot of interest and a lot of demand.
I like it. And you mentioned the AUM growth, obviously tremendous to hear. This is an OM fund, so it's accredited investors only. Where do you find you're getting the most interest between, discretionary PMs, advisors, maybe funds or institutional? Where are you finding your conversations most these days?
Just to qualify that comment, it's an OM fund and it's actually eligible investor. But I would say virtually 100% of our capital has been sophisticated, ultra high net worth institutional style capital. We just launched with DealSquare. I expect that to change quite rapidly because we are on the shelf with a number of broker dealers, and we're, every week we're trying to expand that universe. And from the perspective of constructing portfolios, because I always like to come back to the basics, when advisors are talking to clients, I think that some allocation to farmland should at least be under discussion, right? Because there's a number of reasons why you might want to include it. So I think that once those discussions start happening, we're going to see a lot of retail capital in addition to institutional capital, which doesn't really need to be convinced. They just need mechanisms to deploy into the space, right? So, our expectation is that we're aiming to add $100 million of LP capital, a minimum per year on a go-forward basis into the open-ended vehicle. I think that we're going to be pleasantly surprised and outperform that. But let's just say that that's our target for today.
We'll go conservative. I like it. And the DealSquare platform ultimately is there to help market make that process easier, more efficient, and fit into I would say the traditional IROC advisory business here in Canada in a more intuitive way. You've got your ticker. I think one of the better ones I've seen on the platform as well. It's pretty prescriptive. Talk to me a little bit about the properties or the farmland that you're seeking to include in the portfolio. I know there's an interesting opportunity and story behind that.
Yeah, so one of the things that obviously we have to solve as managers is that farmland ownership, the regulatory environment for farmland ownership is a provincial jurisdiction. And so the rules actually do vary province by province. And one of the things that we spent some thought on prior to launching was how to create structures that, as simple as possible, that opened up the investment to the largest potential universe of investors, and basically made all that complexity go away. And so what we landed on was to have two vehicles. They're sister vehicles. They act in conjunction. They have the same compensation structures, the same offering features. They're identical. One fund targets Canadian farmland, excluding Saskatchewan and Manitoba, and its sister vehicle targets only Saskatchewan and Manitoba. So there's no overlapping geography. And depending on the nature of the investor, they either invest in both vehicles or just the UR vehicle, we call it, which is all of Canada excluding Saskatchewan and Manitoba. And this isn't sort of trivial complexity, it now allows virtually any investor to get exposure to the Canadian farmland thesis, simply by filling out one subscription agreement or two. I mean, it's no more complicated than that. And all the provincial jurisdictional complexity around ownership has been solved just through this configuration. And of course, by going open-ended, we've solved the other issue, which traditionally we had to deal with, was we would have investors, and we've had these discussions and we've had capital from investors like this who have a 20-year duration, right? A pension plan looking at this asset class will typically say, this is a fantastic set of qualities, and particularly the very small likelihood of a down year, and a down year is going to be small, we'll hold this for forever, basically, right? And in fact, if I was making recommendations to people, I would suggest they err on the side of a long hold period. But then there are, retail investors whose holds just can never be that long, right? And so we've always struggled to find a solution for that. And the open-ended vehicle, two open-ended vehicles working in conjunction, solves the ownership compliance issues. I don't describe them as issues. They're just regulations that you have to comply with. And it also solves the duration piece. So now very large institutional investors can coexist with retail investors, and retail investors can coexist with corporations that aren't, entirely owned by Canadian citizens. And so you get the point. It's basically, as much as possible, trying to democratize access to the strategy. It's not just for pension plans. It's for basically, by choosing which fund you participate in, it allows a very broad range of people to get access to the strategy.
I like that. Now you're speaking our language here at NEO, democratizing access to unique investment opportunities across the board between private and public markets. This certainly obviously checks a number of boxes there. A question from our audience and related to the topic around property management. Are you outsourcing it? Are you guys running it as a team? How's that functioning internally?
Oh no, we've always internalized that function. I mean, making investment decisions, monitoring, finding renters, escalating rents, the annual monitoring is a critical skill. You can't outsource that. I mean, you create massive agency risk. You've got someone who has no skin in the outcome, meaning the IRRs generated, making critical decisions. So we've built software platforms from scratch, monitoring systems. We do all of that ourselves. We have to. It's a core function of our business, is to make property selections, vet renters, collect rents, monitor how the land's being used. And we have a two-pronged process. We actually get online reporting from the farmers, and then we have a field team that goes out and confirms those reports. So that it's a really critical function, and it's part of the sort of material value add that we bring as managers, and it's all in-house.
Brilliant. Thank you. Hopefully that addresses the question. I think that's a very clear and concise answer. Teams adding value, and you've got some very credible history in the space that I think would uniquely qualify you and the team to doing that and adding the value for your investors longer term. Makes sense. Looking at the value prop of Canadian farmland, this is one of our topics from all of our discussions leading up to the launch, and in fact I think we got a very short presentation on the topic through the market open. But you talked about low operational risk. Tell me a bit more about that and how that factors into your property selections.
So if you permit me some latitude, I'm going to sort of answer three questions at once.
Fire away.
Because it's really important to flag for potential investors what we're trying to do here and the return driver we're trying to capture. So if an investor was to take the developed market, take all the farmland and throw darts, you would capture a relatively high nominal non-volatile rate of return, because farmland actually across the developed market tends to behave that way, right? But now come to Canada, we have something really unique and really powerful as far as a return driver, is we have this really pronounced product value proposition. Like on a fundamental basis, and I'm going to explain what I mean by that, but on a fundamental basis, Canadian farmland is about 50 to 60% discounted to its developed market peers. And there's a metric we use to arrive at that conclusion, which is we're unconcerned about the raw price per acre. because that doesn't really tell you a lot, right? What we pioneered when we started in this 13 years ago now was the idea of what is the productivity adjusted price? What is the price for a ton of wheat growing capacity? And interestingly, when you do that research and you look at all the developed markets, you see globally a very consistent price for a ton of wheat growing capacity. It's about 6,000 Canadian dollars. Now, you would expect there to be a consistent price, right? Because it all produces a spot commodity with the same price. Transportation costs they're at the margin, they're largely the same. Property ownership, technology is the same, and machinery is the same. So you would expect there to be effectively a single price for a ton of productive capacity and to be very consistent across all markets. It is, with the exception of Canada. In Canada, that same ton of wheat growing capacity on average is about half the developed market price. And in Western Canada, it's about a third. And I always say ignoring all the other really interesting features of farmland, which you would get, as I mentioned, by throwing darts, in France and in Germany and in America, you would tend to capture those features. In Canada, you get the thing that I'm most interested in as an investor, which is value, right? Because value is, we all know that if you can find a value proposition, which today is extremely difficult, and you can fundamentally demonstrate it exists, it's a very powerful return driver, because we all know that mean reversion is then your friend, right? That there's going to be mean reversion to the average, and that's going to provide additional impetus to Canadian farmland returns. And it's this that we are trying to capture in that non-volatile, non-operated, cash-rented way. And it's why we've been able to generate in our legacy vehicles, we have land IRRs, like land portfolio returns, in the range of like 11 to 21% without leverage. I mean, we have generated what I would argue for an alternative fund would be, top decile returns, but we did it without leverage, and we did it without complexity, and we did it in a way that everybody on this webinar understands, right? We held a diversified, non-operated portfolio of farmland. And so for me, this is really powerful, because you get an interesting asset class with interesting portfolio features, but you get a demonstrable discount, which in today's world, it's virtually impossible to find anything that trades at a discount, right?
No kidding.
Anyway, sorry, I probably didn't answer your question, but I really wanted to, draw attention to this, because at its heart, this is the additional and very powerful source of return that we're capturing.
And it makes perfect sense to lead with that and highlight those points, because those are things also that will ultimately separate the thesis from maybe the two quick questions I'm going to bounce at you now from our audience. Just a quick confirmation from your remarks earlier. The only difference between the URLP and the RLP are the provincial targets, right?
Yes. And
Perfect.
so, and just to repeat that, our return expectations are the same for both funds. They're both able to access that discount, this discount on this page, at a size that's, they can both access sufficient land at a discount that we expect both their returns to be similar. Not over any one quarter, but over the medium term, we don't expect there to be any material deviation.
Brilliant. And maybe a related question, and it ties into your statements around comparing Canadian farmland versus other markets. You talked specifically about developed markets. Question from the audience was, how does the Veripath funds stack up against farmland funds in other jurisdictions like China, Brazil, maybe some more or less developed economies than ours? Any other comparisons that you might otherwise stack up against?
Actually, it's surprisingly, although there are emerging markets where, they are discounted to this global average, Canada is still competitive to a lot of emerging markets. And like I can assure everybody on this webinar that you don't get paid to take political risk, right? I used to work for a big French bank, and my job was to do private equity investing in the emerging markets. And those emerging markets were the former Soviet Union and the Middle East and North Africa. And when something was politically sensitive, our expropriation odds went through the roof. And so the reason why, we could capture a slightly deeper discount by going to Venezuela or going to Argentina. The issue becomes that when political risk manifests itself, you don't just lose a little bit of return, you just get expropriated and you lose all of your return, right? Yep. And I would argue that farmland is the most politically sensitive asset class you can imagine. And so for us, there was never a moment where we said, let's go for an even deeper discount, even slightly bigger, but let's onboard political risk, because you just don't get compensated for it. And so while there are emerging markets that do trade at even slightly lower productivity adjusted prices, the political risk you onboard isn't worth the extra potential return, right? And so for us, it was always, and I get back to what I said originally, is to capture incremental demand for soft commodities in a politically safe, expressed in a politically stable and safe environment, right? And that's Canada. And unfortunately, in Canada, you have a really big discount as well.
Brilliant. I think those are key points you've driven home very well over the course of our chat. We've talked a lot about the upside, though. We've got only 3 minutes left to go, and holy smokes, time flies. Where do you see the risks with this particular fund or the asset class? What are things that an advisor or a high net worth investor should be aware of?
So there's the generic catch-all risk, right? Which is any non-volatile strategy can be destroyed with too much leverage, right? And so our target leverage is 25%. And it's just to smooth out capital, which is monthly, and acquisitions and dispositions, which is spring and fall. So I would say that, we've thought of that, and we intend to run, at very moderate levels of leverage. The other risk in a farmland fund is the obvious non-diversifiable weather risk, right? That you have weather that you just can't diversify in your geography. Now in Canada, we have the second largest country in the world. We have 165 million acres across 5 time zones. So a weather event that we couldn't diversify geographically is the largest, most catastrophic weather event humanly possible, yep, which I would argue would impact all farmland funds, right? Now, having said that, we do measure like local weather risk in the sense of local productivity trends, because that's a proxy for some consistently changing weather, right? And one thing we also do pick up because of our investment screens is that crops are moving north. I mean, one of the and I won't delve into what rapidly becomes a political discussion about global warming, other than to say, like, productivity in northern latitude countries is expected to go up, and crops are expected to move north. And so it's another actually source of return for us, is we tend to see, because we're geographically diversified, you actually tend to see the growing conditions improve in Canada. I know that seems counterintuitive, but it is the case, right? So that would be the thing I'd be looking out for as an investor, is how geographically diversified you are, because weather is an issue. And have you turned something that's non-volatile into something that's volatile through the inappropriate use of leverage?
Brilliant. I think that sums it up nicely. Stephen, we're right on the money here, and you've shed a lot of very interesting information, I think, for our audience. If there was one other thing, 30 seconds or less, that would be hitting your radar that you haven't had the chance to share with our audience today, what would it be as a parting thought?
Correlation. I hear a lot of funds and strategies talk about their long-term correlation behavior. What they never discuss is their short-term episodic cross-correlation, meaning there's a financial crisis, we've all experienced it. Everything goes positively correlated, right? The thing that really attracts me to farmland, which is sort of like step number 1 in incorporating in someone's investment portfolio, is that you get genuine diversification benefits, which are maintained during episodic financial events, because it doesn't suddenly become correlated, right? Which then destroys the entire purpose of diversification, is that it's supposed to protect you from events, not trends, right? And that is something unique. When I look at a lot of alternative strategies, they tell you their 30-year cross correlation, but they don't tell you their 1 month cross correlation, because it's very different, right? Farmland isn't. Like, the correlation benefits are maintained over long and short periods of time.
Brilliant. Well, with that, I'll keep to our commitment to our audience today. Obviously, Stephen, it's very clear you've got an incredibly interesting high-level opportunity backed by substantial experience and expertise. I think that the comment made, obviously, from this, and certainly from my perspective, grateful for the time you've given our audience today.